Welcome back to Investing Talk podcast. Today, we're really digging into a company that's seen, well, a huge financial turnaround this quarter, EON Resources. They're an energy player focused right in the Permian Basin. And yet they've gone through some major changes over the last 3 months. So our job today is to cut through all that noise, look at what the sources are saying, and figure out if these changes actually make it a good buy right now. And hey, if you like this kind of analysis, please do subscribe, hit that like button, and definitely leave a comment below. We really want to hear what you think. And if there's another company you want us to check out next, tell us in the comments. Okay, let's unpack this.
There has been a significant amount of action. A lot going on over the last 3 months that fundamentally changes the structure of EON Resources. We're talking about clearing out old debt, getting ready for, well, a pretty aggressive growth phase. The sources point to some really big financial shifts, especially August and September this year. So what were the absolute key financial moves here?
Yeah, it's fascinating because the goal wasn't just, grab some cash. It was about fundamentally de-risking the whole company. The core of it was that $45.5 million funding package they locked down in September. This wasn't just keeping the lights on, it was strategic capital.
Okay, so break down where it came from and where it went.
Right, so the lion's share, $40.5 million, that actually came from a private family office, which is interesting, right? Sophisticated money. And the other $5 million came from Virtus Energy Partners. That's important because, well, they're also their main operational partner moving forward.
Ah, okay. And the money went to?
Critical uses. $19.3 million straight to retiring senior debt. That's huge. And another $20.5 million to handle a big seller settlement obligation they had.
Retiring senior debt, that's really the key takeaway there, isn't it? It's more than just less debt. It changes their whole risk profile.
Precisely. If we connect this to the bigger picture, getting rid of that senior debt massively improves their capital structure, makes future financing easier. It basically shields the assets from the most immediate threat, lenders calling the debt. They went from a kind of distressed situation to potentially a pure growth story, all because they cleared those top priority debts.
And I saw something about them making a smart move before that funding even closed, with Pogo royalty.
Yeah, that was clever. It shows good management, I think.
Yeah.
Back in August, they tweaked their deal with Pogo royalty. They cut the cash they owed by $1.5 million and, just as important, reduced the stock they had to issue by 1.5 million shares.
So less dilution even before the big funding round hit.
Exactly. That kind of preemptive move is a great signal. They knew they needed to control every dollar and, crucially, the share count before this big package landed.
Okay, so the balance sheet looks cleaner, the debt's more manageable. But, a clean runway doesn't help if you don't have a plane. What's the actual growth engine they're trying to fire up in the Permian now?
Well, the engine starts with the assets themselves. Back in June, remember, they bought the South Justice Field. That added 208 wells producers and injectors, plus about 20,000 acres. Right away, that boosted their output over 1,000 barrels a day.
Okay, so some existing production there.
Yes, but the real scaling mechanism, the future growth, that comes from the farm-out agreement.
Right, that partnership with Virtus Energy Partners again. How does that work exactly? How does it give them growth without, breaking the bank?
It's a pretty standard but smart risk-sharing strategy. Virtus takes the lead operationally. They put up most of the capital expenditure, and they get a 65% working interest.
And EON?
EON keeps a solid 35% working interest. And this whole deal targets up to 90 horizontal wells in the San Andres Formation.
90 wells, wow.
Yeah. And the beauty for EON is they get 35% of the potential upside from all those wells, but without having to front the huge drilling costs themselves.
That definitely lowers the risk on their growth plans. Okay, now here's where it gets really interesting for me. The insider sentiment. When management cleans things up financially and then starts buying shares with their own money, so that's a signal you can't really ignore, right? What did the sources show for Q3 buying?
Oh, the insider commitment is maybe the most compelling piece of the bullish argument here, qualitatively speaking. Management, directors, they bought a total of 1,076,000 shares right on the open market in Q3.
Over 1 million shares?
Yeah, and get this. That includes a recent burst of 411,000 shares bought just in October, right after the funding was sorted and the drilling program was set.
Wow.
That kind of buying, open market purchases, it screams confidence from the top leadership. High confidence right now.
Absolutely. But, okay, we got to balance that excitement. Let's look at valuation and risk. As of October 10th, the market cap was around $22.14 million, and the price-to-book ratio was 0.73. What does that PB really tell us?
Well, that 0.73 PB is what value investors often look for. It means the market's valuing the company at like 73 cents for every dollar of assets reported on its books.
So below asset value.
Right, roughly 27% below the accounting value. It suggests that, on paper at least, the assets they have are undervalued by the market currently. It's a classic value signal, and it lines up with that insider buying.
Okay, but we can't ignore the elephant in the room here, tied directly to that funding, the dilution. Getting that cash was necessary, sure, but it came at a huge cost to existing shareholders, didn't it?
It did. And this is, frankly, the single biggest risk factor that you, the listener, have to weigh. The share count exploded. It's up by a massive 410.63% compared to last year.
400%.
Over 410%, yes. Now, the cash was used well, paying off bad debt, funding growth plans, but a fourfold increase in shares means any future profits get split among way more owners.
So the growth has to be enormous just to keep pace.
Exactly. It needs to be incredibly explosive just to justify where the price is now, let alone hit those bullish targets everyone's talking about.
That's a really important point. So why would analysts, why would insiders accept that kind of dilution if the assets are really worth more? What's the calculation there?
It's a bet on unlocking value. The thinking is that those assets, if they're just sitting there undeveloped or trapped under a mountain of toxic debt, they aren't worth much in practice. Management basically calculated that unlocking the operational potential, through that Virtus farm-out deal and clearing the debt, was worth the dilution hit.
So it's a gamble on execution speed.
It's an aggressive bet on execution speed, yes. They're betting that their 35% slice of the revenue from those 90 potential wells, plus their existing production, will ramp up fast enough to overcome the drag from all those new shares.
Understood. Definitely high risk, but potentially high reward. Okay, let's shift focus a bit, looking ahead now. If this execution bet is going to work, what are the key events or catalysts we should be watching for over, say, the next 3 months?
Yeah, the calendar looks pretty packed, actually.
Yeah.
It suggests it's going to be a busy period for the stock. First up, we're expecting the Q3 2025 earnings release. Dates are a bit loose, sometime late October maybe, or by November 24th. The key number there is the consensus revenue estimate, $10.67 million.
And how does that compare to Q2?
It's a sharp recovery, more than double the $4.6 million they reported in Q2. So hitting, or ideally beating that number, would be a huge validation that the cleanup worked.
Okay, what else? Beyond earnings?
There are some market mechanics to watch.
Yeah.
Around November 15th, there's a window for ETF and index rebalancing. Could see some passive funds having to buy or sell. But maybe more telling for institutional belief will be the 13F filings. We should see those around December 8th.
Right, the 13Fs. Remind us quickly what those show.
Sure. They're quarterly reports where big institutional investors think hedge funds, large asset managers have to disclose their stock holdings. Seeing who might have been buying EON shares during all this restructuring, that'll be a really crucial sign of whether this smart money believes in this turnaround.
Gotcha. And operationally, how do we know if that Virtus drilling program is actually working?
We should get the first real taste of that around mid-December. They're expected to release a Q4 operations update, including initial drilling results, around December 15th. The market's going to be intensely focused on how those first San Andreas wells perform. Success there validates the whole strategy. Failure, well, that's a problem.
Okay, stepping away from the official calendar, what's the buzz, the market chatter? What's driving some of the recent trading volume?
Well, the speculative side is definitely humming. Beyond just hoping the drilling goes faster, sources mention whispers about potential expansion of joint ventures in the Permian. Like maybe other partners want in?
Interesting.
But the really juicy rumor, the one causing a lot of chatter, is potential takeover interest.
A takeover? From who? Bigger players.
That's the speculation. Larger independent oil companies, maybe private equity firms, looking to snap up de-risked assets in the Permian. By cleaning up its debt and starting to prove out this 90-well model with Virtus, EON basically makes itself a much tidier, more digestible acquisition target.
Makes sense. Okay, so with all this going on, the fundamental shifting, the technicals, the rumors, what's the overall analyst view? The sources mentioned a strong buy rating?
Yeah, the professional consensus is definitely aggressive, strong buy.
Yep.
And the average 12-month price target reflects that. It's set at $2.
$2. Wait, the stock's around 50 cents now. That implies what, a 260% upside?
Roughly, yeah. Around 259%, 260% potential upside from current levels. It's exceptionally bullish.
Okay, that sounds almost too good. What kind of assumptions are baked into that $2 target? They must be assuming near perfect execution on those wells, right?
They're definitely assuming strong execution. Two key things, really. First, that Q3 revenue number, the $10.67 million, gets hit or beaten. That proves immediate cash flow generation. Second, they're assigning a much higher value multiple to the company now. They're looking past the recent issues and valuing it based on the potential of that large reserve base. The assets, now that the debt risk is lower and the dilution, well, huge, is kind of known.
So they're betting heavily on that 90-well program, delivering big production increases fast.
That's the core of the bet, yes. Rapid, substantial production growth.
All right, last check. The technical picture. Stocks trading around 0.56 40-day. Is the chart confirming this bullishness, or is it still messy?
The chart does confirm medium-term bullish momentum. The price is above both the 50-day and the 200-day moving averages. That generally indicates accumulation is happening.
Why sense a but?
Well, the volatility is wild. Daily swings of 6% to 18% are common. This is not a stock for someone who wants a smooth ride.
So good for active traders, maybe, watching for dips.
Potentially, yes. The technical setup favors active accumulation in a very volatile name. Definitely not for the faint of heart. And just before we wrap up, let's quickly reiterate those two main risks you absolutely have to keep in mind. First, even with the expected recovery, there's still the risk of revenue being choppy, maybe continued net losses for a bit. Q2 revenue was really low, remember?
Right.
Second, even with the new financing details, the public filings aren't super granular on all the current debt terms or exact cash flow projections. There's still a little bit of uncertainty baked in there.
Okay. So what does this all mean? Pulling it all together, you've got this dramatic balance sheet repair, you've got the launch of what could be a major revenue driver with the Virtus drilling program, and you have that undeniable aggressive insider buying. It builds a strong case, definitely a high-risk case, but a rationale for that strong buy consensus we talked about. The company seems to be shifting from just surviving to actually growing.
Exactly. It's moving from financial triage to operational execution. And that operational potential is really the closing thought we want to leave you with. Remember, EON's own Q2 report mentioned their assets having a potential economic value using that NPV10 metric of over $95 million.
Okay, NPV10, again, quick definition.
Right. Net present value of future cash flows from their oil and gas reserves, discounted back at 10% per year. It's the standard industry estimate of future asset worth. In their case, that's based on about 10 million barrels of oil and 6 billion cubic feet of gas they think they have.
So significant potential value identified.
Yes. So the big question now, the one investors need to grapple with, is this. With those major financial roadblocks seemingly cleared, how fast can EON actually turn that identified $95 million potential into real, tangible earnings and positive cash flow? Fast enough to justify that huge 410% increase in the number of shares out there.
That's the multi-million-dollar question, isn't it? Excellent point. Something for all of you to really consider as you weigh the risks and potential rewards here. Thanks for joining us for this look at EON Resources. We'll catch you on the next one.